Hey, beautiful people, let's talk about escrows today. Disclaimer up front, my hands are greasy because they got lidocaine on it because they hurt like crazy. So if you see me doing this, that's why. So, escrows, I'm going to read to you the definition, then I'm going to explain, that little ins and out of it. So, escrows is a financial arrangement where a neutral third party holds assets or funds on the behalf of two parties in a transaction. The third party, called an escrow agent, manages the funds until the transaction is completed or a contract is fulfilled. Escrows is commonly used in real estate transactions. That's what we want to talk about, mortgage. So what happens is when you have, and you don't always have to have your loan to value over 80%. Some people just don't want to deal with paying property taxes and homeowners insurance. And they decide, like, hey, I want to escrow. So, anyway, escrow usually comes with, like I said, either the person don't want to be bothered or your loan to value is over 80%, unless it's a FHA or a USDA loan, DA loan, then you will always have to escrow, because with FHA and USDA, your loan to value will always be over 80%. This is something else. Will always be over 80%, right? Now, usually what the underwriter does, she have the closer to hold a certain amount of reserves money into an escrow account for your property taxes and your homeowners insurance. And what happens is when you escrow, that monthly, the money that they are hold into the escrow account, and for those reserves that they charge you at closing, goes into this account. In addition to, when you make your monthly mortgage payment and you are escrowing, your homeowner's insurance and your property taxes get added to your monthly mortgage payment. And when you send that in, that money, the additional money for the homeowner's insurance and the property taxes, then goes to the escrow agent. The bank, the institutes that's holding those particular funds for your property taxes and your homeowner's insurance. Now, a lot of people think that their monthly mortgage payment goes up when their taxes goes up. But actually, your monthly mortgage payment, your principal and interest, will always be the same unless you are doing a ARM product. So this is how it goes. When you see someone says in a video, oh, my monthly mortgage payment went up. No, it did not, unless it's an ARM loan. What happens is property taxes. A lot of times people move into their dream home that is in a new subdivision and the taxes haven't been assessed correctly or fully. I would say, not, I ain't gonna say correctly, I'm gonna say fully, and see what the underwriter does to put it into your loan to value, your total loan to value, your debt to ratio, is they take an assessment. And so they take the assessment usually off the appraisal report, and then they will assess that amount, and then they divide it into 12, and that will become your monthly property tax amount. Your homeowner's insurance is different because they do have a monthly payment for those, for homeowners insurance, although a lot of times they will have that paid up in a year or two and put that into an escrow account. They will have you to pay that. Reserves of money will be held, and that too will be added to the escrow account. The reason why it's so important, more so about the property taxes than it is about the homeowners insurance, because again, if you go and you get a new construction home, or if you in a new subdivision, your property taxes is not assessed fully, and then the underwriter goes off of the appraisal. So maybe next year the assessor assesses the taxes fully, and then you will see a jump in your monthly mortgage payment. And so your escrows have went up. I think I'm saying it correctly. So your escrows went up. Those two, homeowners insurance and property taxes, is added to your monthly mortgage payment. So your escrows went up. Technically, just your property taxes. I haven't really seen in 20 something years the homeowners insurance increasing or going up. It usually is what it is, but it be those property taxes. I will say this: whatever you do, every other month, go on your county tax website, look to see, make sure them property taxes, I say quarterly, because a lot of states, it depends on the county too, because some of them only do like twice a year. Some do quarterly. So you have to check to see when taxes are paid, according to your county, and then go and make sure them taxes is paid. Check to make sure your taxes are paid. Also, the servicer, which is the bank, the lender, they will send you out a letter that states like, hey, your taxes have increased, so your new monthly mortgage payment would be XYZ, right? And even though we keep saying your monthly mortgage payment, it's technically your escrows, because you don't have to escrow. Because if your loan to value is over 80%, you can get an escrow waiver, but you will have to pay for it. It costs usually 1/4. A lot of lenders though are waiving the fee for escrow waivers, right? But usually you have to pay for an escrow waiver when you are over 80% loan to value. And you want to pay your own property taxes and your own homeowners insurance. And so that waiver can take place, but escrows is technically just homeowners insurance and property taxes in an institution held by an escrow agent who manage the money that's being placed in there to make sure these particular bills get paid. Homeowners insurance and property taxes. Again, do not confuse your true monthly mortgage payment, which is your principal and your interest, as not being your true monthly mortgage payment, because it is. Again, the escrows is added and they call it a monthly mortgage payment, but it's escrows. And they call it escrows is because they hold it into a bank. I hope this helps. So like, follow, and share. One thing too, I don't know if I mentioned it, but if you don't pay your property taxes, this is the most important thing. If you don't pay your property taxes, someone can legally come and buy your property taxes. Not buy, I mean pay for your property taxes legally, even though they're yours, but they can do this legally. And within 2 years, if you have not caught up or paid your property taxes, they then can take your house. So not only do you have to catch up on your property taxes within 2 years, whatever interest it has accumulated, you have to pay that as well. And it go to the person who purchased your property taxes. So a lot of times we look and think like, hey, I got a blessing. My tax, nah, check it out, check it out. I hope this helped. Like, follow, and share.